Welcome to Smart Dollar Mindset, the channel where we help you achieve financial freedom through smart money habits and strategic investing. Today, we're tackling a topic that very few people think about until it happens. What should you do if your bank fails? Most people assume that their money is completely safe in the bank, but history and recent events remind us that banks can and do fail. From the Great Depression of the 1930s to the savings and loan crisis of the 1980s, and even in recent years with high-profile collapses of regional banks, the reality is that the banking system, while resilient, is not infallible. The good news is that when banks fail, there are protections in place, steps you can take, and strategies you can follow to protect your money and your peace of mind. In this video, we'll walk through exactly what happens when a bank fails, what you should do immediately, what protections you actually have, and how to safeguard your finances long-term. Stick with me until the very end, because we're not just going to cover the mechanics of a bank failure, we'll also break down the mindset and strategies you can adopt to ensure that no matter what happens in the financial system, you'll always stay in control. The first thing to understand is what a bank failure actually means. A bank fails when it no longer has enough assets to cover its obligations to depositors and creditors. This typically happens because of poor financial management, risky lending practices, economic downturns, or large-scale withdrawals that drain liquidity faster than the bank can handle. When a bank fails, the Federal Deposit Insurance Corporation, better known as the FDIC, steps in to protect depositors. Most people don't realize that the FDIC exists specifically for this reason. It insures deposits up to a certain limit, which as of today is $250,000 per depositor, per insured bank, for each account ownership category. This means that if your bank collapses, the government has your back, at least up to that limit. For example, during the 2008 financial crisis, Washington Mutual, the largest bank failure in U.S. history at the time, collapsed with over $300 billion in assets. The FDIC immediately stepped in, and depositors were able to access their insured funds without losing a dime. The key takeaway is that if your balance is within FDIC limits, you are very likely protected. But if you have more than that in one bank, things get trickier. So what should you do if you wake up one morning and see headlines that your bank is failing? The first step is to stay calm. Panicking often leads to poor financial decisions. Understand that the FDIC is prepared for these situations, and in most cases, insured depositors have access to their money within just a couple of days. Your next step is to verify your deposits. Check how much you have in the bank and whether it falls under FDIC coverage. For example, if you have $180,000 in a checking account, you're fully insured. If you also have $100,000 in a joint account with your spouse, that's also fully insured, because joint accounts are insured separately. But if you have $500,000 sitting in one single account in your name, only $250,000 is protected, and the rest could be at risk. This is why diversification isn't just for investing, it's also for your banking relationships. If you have more than $250,000, it's wise to spread it across multiple banks, or use account categories strategically, like joint accounts, trust accounts, or retirement accounts, all of which may increase your coverage. Now let's talk about access to your money during a bank failure. One of the most frightening aspects for depositors is not being able to access cash immediately. When a bank is closed, debit cards may stop working temporarily, checks may bounce, and access to online accounts may be restricted. That's why it's always wise to keep an emergency fund in a separate bank or credit union, and even some cash at home in a safe place. Think of it like financial redundancy. Just as you wouldn't keep all your important files on one computer without backups, you shouldn't keep all your money tied up in one financial institution. Even if your funds are insured, having all your liquidity frozen for several days can cause unnecessary stress and problems. Take the example of the Silicon Valley Bank collapse in 2023. Thousands of startups and small businesses suddenly found themselves unable to access payroll funds. Many of these companies had millions of dollars in accounts well above FDIC limits. For them, the uncertainty was devastating, and some businesses were forced to scramble for emergency loans just to pay employees. This is a powerful reminder of why no one should assume it can't happen to my bank. Once you've secured your immediate liquidity, the next step is to evaluate your exposure. Do you have CDs, savings accounts, or investment accounts tied to the failed bank? FDIC coverage does not extend to investments like stocks, bonds, or mutual funds, even if they are purchased through the bank. Those are separate accounts, often protected by other systems like SIP for brokerage accounts. Understanding what is insured and what isn't is critical to making informed decisions in a crisis. At this point, communication is key. The FDIC usually releases information about what's happening with your bank, whether another bank has acquired its assets, whether insured deposits have been transferred, and what steps you need to take. Stay updated through official announcements, not social media rumors. In a financial crisis, misinformation spreads fast and can cause unnecessary panic. Let's shift gears to prevention, because the best time to prepare for a bank failure is before it happens. Here are some smart strategies. Know your coverage, familiarize yourself with FDIC insurance rules and structure your accounts to maximize protection. Diversify your banking, don't keep all your deposits in one place. Use multiple banks or credit unions. Maintain an emergency fund outside your main bank, keep a portion of savings in a separate institution and some cash on hand. Be mindful of risk signals. If your bank is in the news for financial troubles, pay attention. While you don't want to panic, it may be wise to adjust your deposits. Don't assume investments are covered stocks, bonds, and mutual funds are not FDIC insured. Make sure you understand where your investments are held and what protections apply. Real-life history provides valuable lessons here. During the Great Depression, before FDIC insurance existed, thousands of banks failed and millions of Americans lost their savings overnight. People literally went to bed financially secure and woke up broke. The FDIC was created in 1933 to restore public trust in the banking system, and since then, not a single depositor has lost insured funds. However, uninsured funds are another story. In the 1980s savings and loan crisis, many depositors with balances above insurance limits suffered huge losses. Fast forward to today, and the same lesson applies. Protect yourself by staying within insured limits or diversifying. Another crucial step is to keep your long-term financial plan in mind. Bank failures, while stressful, don't necessarily mean disaster for your overall wealth-building journey. In fact, moments like these are reminders of why personal financial education is so important. By having a plan, a budget, diversified accounts, and a clear understanding of your money, you'll be far more resilient than those who simply react in panic. Consider this: wealthy families don't keep all their wealth in one place. They spread it across banks, investment accounts, real estate, businesses, and more. This diversification is a shield. You can apply the same principle, even on a smaller scale. Final thoughts. So what should you do if your bank fails? Stay calm, know that insured deposits are protected, secure immediate liquidity, evaluate your exposure, follow official instructions, and prepare for the future with diversification and smart money habits. But beyond the practical steps, there's a deeper lesson here. Financial security doesn't come from assuming the system will always work perfectly. It comes from building resilience into your personal finances. It comes from understanding the risks, preparing for them, and structuring your money in a way that keeps you safe no matter what. The reality is that banks are just one piece of your financial puzzle. They are tools, not guarantees. By taking responsibility for your own financial future, by learning how money works, by managing debt wisely, by building investments, and by creating multiple streams of security, you gain control over your financial destiny, regardless of external shocks. The message here is clear: don't wait for a crisis to start taking your financial life seriously. Prepare now, so that when challenges come, you'll already be in a position of strength. That's the mindset shift that separates those who struggle from those who thrive. Thank you for watching Smart. If you found this video valuable, please subscribe, hit the like button, and share it with someone who needs to hear this message. Remember, this channel is all about helping you achieve financial freedom with smart money habits and investing. Stay tuned for more content that will not only prepare you for financial challenges but will also help you build the wealth and freedom you deserve.